Good morning. Thanks everyone for being here. Thank you, President Daly, for being here as well for a discussion facing an uncertain world, the Federal Reserve and climate risk. Mary Daly and I, the president of the San Francisco Fed, will discuss climate risk and how the Fed is thinking about it and how she is thinking about it. And after our discussion, we'll take some of your questions. Thanks again to all of you for joining, and thanks to everybody who will be watching this video after we've finished our discussion. Instructions for submitting questions: please email your questions to mariana.mitchell@aei.org. You can find her email address on the event webpage, or you can submit questions via Twitter at #AskAEIEcon. That's #AskAEIEcon. Let me offer a brief introduction of President Daly. Of course, she doesn't need an introduction. It's been such a leader on monetary policy issues and economic issues more broadly. Mary C. Daly is the president and CEO of the Federal Reserve Bank of San Francisco. She took office in October of 2018 and began her career with the San Francisco Fed in 1996 as an economist specializing in labor market dynamics and economic inequality. She went on to become the bank's executive vice president and director of research. She currently serves on advisory boards for the Center for First Generation Student Success and the Maxwell School of Citizenship and Public Affairs at Syracuse University, where she received her PhD. She is a native of Baldwin, Missouri, just down the road from Kansas City, where I grew up, which is why we're both so imbued with basic common sense. And I'm just so happy to be hosting her for this conversation. Mary, thank you so much for being here.
Thank you so much for having me. What a pleasure.
So let's dive right in. I guess the first question that makes sense to ask is, why do you view climate risk as something that should be on the Fed's radar?
Sure, it's a terrific question. And I always like to start by saying what it's not. So we are not climate scientists. We do not have any of the levers that the fiscal agents in our economy have to mitigate climate change. But we are, by definition, students really, to do good policy of the economy that surrounds us. And for those of you, I think everybody knows this, but it's always useful to remind people, we have three core missions that Congress has given us. A stable and sound payment system. That's how we get inventories of cash and electronic payments across the country. A safe and sound, stable financial system with other regulators, ensuring that banks are well capitalized, that they see the risks that are around them coming, and that they're well equipped to be helpful when we have downturns by lending and facilitating growth in good times. And then, of course, monetary policy, how the economy is functioning. And all of climate risk affects all of those core responsibilities. Just a simple example is when you have severe weather, even heat and ice storms that interrupt transportation networks, that's really hard on cash inventories. And if we don't have cash in the banks when people want to go get it, that causes people to be unhappy, basically, and also worried. So that's a core responsibility for us. On the financial side, it's both, how do we think about banks? We're risk mitigators with banks. We're risk analysis with banks as our regulators and supervisors. So how do they feel ready to insure against the risks that are before us? And you see this happening already. Banks are doing this themselves. And so in many ways, the Federal Reserve is acknowledging what banks have been starting to do and saying, this is really important. And how can we be helpful ensuring that all banks are thinking about these things? And then on monetary policy, I liken this to, we study trade policy. We study welfare reform when it was happening. We study everything that affects directly full employment and price stability, because those are our core responsibilities that Congress gave us. And that's why we're thinking about these. Students of the economy, this is one of the risks facing the economy, an emerging risk that's already shown how devastating it can be in certain areas, and is predicted to be even more devastating as we roll forward. So that's why we think about it. And again, it's not to mitigate climate change or to even pull levers that would do that. It's really to be students of it so that we're well prepared. I will say it simply, we have a narrow remit, but it's a very important remit as we think about these issues.
So I don't think so. First of all, I think defining the problem by what it is not, and defining the scope of action that you think might be appropriate, against what you think would be inappropriate, I think is a very helpful way to think about this, and to help people understand your thinking and the Fed's thinking on it. It seems to me that that your assessment that a changing climate affects economic outcomes is, or at least should be, completely non-controversial. If you have more flooding in certain parts of the country, that's going to affect lending behavior in that part of the country, which is part of the financial system. It's going to affect economic activity in that part of the country, which would include employment. The kind of very clear things that the Fed should be worried about would be affected by a changing climate. But I wonder if you could place into context, how significant you think this is. Is this a big problem? Is this something to keep an eye on? Is this a flashing red light, or is this something that we should have on the radar? There are all sorts of things, of course, that affect the economy. All sorts of topics that economists research, and all sorts of issues that the Fed has on the radar screen. How does this compare, let's say, to economic inequality? How does this compare to concentrations of market power? How does this compare to concerns about leverage in the financial system? I think giving people a better sense of kind of the relative importance of this would help them understand more how you're thinking about it.
Absolutely. And that's a really terrific question, by the way. I never get asked that, and I really appreciate it, because it's helpful to know, are we throwing all of our resources into something, or do we have it on our radar because it's an important emerging risk? I would put it squarely in important emerging risk, but it's started to emerge faster, if you will, in the last couple of years. Let me give you an example. So, 5 years ago, when we really started thinking about this work in San Francisco, it was because we had fires and other things in California and in the district that were affecting how people decided to allocate their resources and think about their economic activity. And that was just the beginnings of it. But subsequent to that, of course, we've seen those types of big events, whether they're fires or hurricanes or flooding or ice storms, really hot weather, be something that the rest of the United States is experiencing in pockets, and the global economy is experiencing. So why is it important now, and where does it stack up? So before the pandemic, we were really focused on trade policy, because the trade negotiations, the trade disputes with China were actually, percolating through everything, and they were affecting economic activity, a strong headwind. So that was at the top of my mind at that point in time. But as a policymaker, I always have my eye on what's currently here. Currently, I'm focused a lot on the pandemic. What are the supply chain bottlenecks doing? When are we getting through the pandemic? How can we get the economy back completely on its feet? But I have to have climate right there, because here's what's happening. It's happening in the 12th district, which I have, but it's happening across the United States. A great example is up in Napa, which I think most people have heard of, produces a lot of wine. If you're a wine grower in Napa, you are struggling to get insurance right now. If you can't get insurance, then your lender's exposed, you're exposed, and people are trying to figure that out. So that land with tremendous value, that's been a big contributing force to the economy there, is now subject to all of these new repricings, essentially. And so that's already starting to find its way into the financial system. The banks that are lending to those, when you don't have insurance, that's a problem. So they see that, they're focused on it, and we're seeing it spread into just where are people going to live? What are they going to do? Migration patterns. So I'd say emerging risk. But if you score it right now, more of my time is spent on the direct concerns of the pandemic and getting the economy back into its long run steady state, focused on trade issues, focused on, you mentioned inequality. Inequality is something we've been noticing for 50 years in the United States. So I would say that's one of those low frequency changing variables, which we have in the back of our mind, but it's really this climate thing that is speeding up in the rate at which it's disrupting things. I'm a little worried, frankly, and I see it already in some areas, that the supply chain disruptions we've seen with the pandemic, which have been nothing short of severe, that those supply chains are also vulnerable to severe weather events globally, and that will be the next part that we have to focus on with the supply chain issues.
So right now you see it as an emerging risk that is manifesting itself in some instances, but mostly, kind of a future problem.
It's a future problem. It's exactly. Sorry to interrupt, but we need to be prepared. So I always have to have my eye, and your listeners might appreciate this. My real focus right now is on inflation and full employment and the pandemic and things of that sort, but I have to keep my eye on emerging risks. Otherwise, the Fed won't be prepared, and then we'll not be achieving our responsibilities to do our best policy because we'll be surprised by the risks.
So how do you see it? And this is a hard question. I think Yogi Berra said that predictions are hard, especially about the future. So with that caveat in mind, where do you see this 10 years from now? Where do you see it 20 years from now? There's a real question. There are lots of risks that face the economy, lots of risks that may or may not materialize, and monetary policy operates on a certain time frame, and monetary policy has to be proactive, of course, because policy actions take place with a lag, but that lag is not of infinite length by any stretch. And so where do you see this 10 years from now, 20 years from now? Do you expect that this will be one of the top 3 or 4 issues facing monetary policy in the decade or two to come, or do you think it'll be in the top 20 but not in the top 5?
Sure. Well, I'm going to start by saying a lot of that depends on how we as a nation, we as a global system manage climate. And if we manage it well, then the risk goes down. There's 2 types of risks in climate that people focus on. One is physical risk, the physical loss of property and lives and production. And then the transition risk, which is how do we get from where we will want to be, where it's not such an important problem because we've already worked on it, versus do we kick it down the road to the point where now it just hits us like a wave, basically. And so that transition risk is really where people are focusing on now. You start early to mitigate the worst of the events, and things aren't as bad as they could be. So all of that is very uncertain and depends a lot on what fiscal agents across the globe do to think about how do we mitigate the climate events that we're seeing. So what does the Fed do? Now, this is where I really think it's useful to think about how climate, trade policy, all of those things, I think of those as very similar kinds of events where they affect the economy in a way that affects our potential output growth and where employment can be located and other things. So you can have it be improving potential output growth or restraining it. So we need to know that so we know how to calibrate monetary policy. So when I think of where will climate be in monetary policy, I'm really not thinking how will I adjust the tools on a regular basis over the 12 to 18 month window that we have, that where policy has its biggest effect. I think of it more as setting the landscape for the economy that I need to understand so that when we go to think, well, what's the right level of employment that would be full employment? What's the right level of growth that would be potential before we start to see inflation? That's how climate affects this. And we're going to have to, think about the data collection we need to do and how we get there. And on but the biggest thing I think, and this is something to also say to the listeners, is monetary policy, we have it in the background almost. It's a factor that affects as I said, the landscape of the economy. The real issue that we focus on now, and you saw yesterday, FSOC came out with their report and Chair Powell issued a statement that we were really focused on how does this affect the financial system? Because if there's a large repricing of assets, whether they're coal producing assets or other assets like the vineyards in Napa, that affects banks, and those banks are interconnected. If we learned anything in the financial crisis, it's that the financial system is a highly interconnected foundation. And if one of them goes down, the other parts start to get wiggly, and we can't have that. I mean, that was so painful. We want to avoid that. And climate is an emerging risk to that. So we have a couple of committees that have been formed in the Federal Reserve, the Climate Supervision Committee, there's Supervision Climate Committee, and the Financial Stability Climate Committee. And they're really focusing on learning, data collection, understanding, scenario analysis, things that allow us to be ahead of that game so that we're not trying to play catch up when the events actually emerge. So I hope that's helpful. I don't see this, and this is the main thing. I don't see this as though a main issue we're responding to on monetary policy on a day-to-day basis. It's really a background factor that affects the landscape of the economy and the output that we have to think about.
So I think that's helpful to help people to understand kind of how you're thinking about this, how you're thinking about climate risk vis-a-vis the financial system, how you're thinking about climate risk vis-a-vis the economy, the time horizon you're thinking about this on, and the relative importance you think this risk has. Why don't we talk about what the Fed can do about it? It's one thing to identify a risk, of course, and it's something else entirely to try to address it. And it's something else entirely to explore whether or not monetary policy can address it, and even if it can, whether or not it should. You have been a leader, and the San Francisco Fed has been a leader in researching this and in trying to understand the effects that a changing climate would have on the economy, understanding the effects that a changing climate would have on the financial system, and that's a big part of what the Federal Reserve System does. Is it produces extremely high quality economic research to just kind of understand what's happening in the economy beyond understanding it better, which is, I think, quite important. What else do you think the Fed can be doing?
That's a terrific question. Again, thank you for asking that. So let's start with the first thing. Our job is to understand. One of the things that the public expects of us is to understand what's going on and then publish that freely, be completely transparent about what we're seeing so that policymakers, citizens, et cetera, can look at it and then make a decision for themselves about what they think we should do. And they can put that decision to the elected officials. So that's one of our roles. And that's what we really focus on here in San Francisco is evidence-based research that is peer reviewed, that just says, here's what the likely impacts are, and here's the uncertainties surrounding those thoughts and projections. So that's a big part of what we do. But then what do we do with it? Well, on monetary policy, I'm going to start there. There's really not anything that I see today that monetary policy can do to offset climate risk or mitigate climate change. It's really, monetary policy is about dealing with the economy that we've been given. So the climate analysis we're doing is to really understand what that economy is going to look like so we can achieve those two goals, price stability and full employment. And that's where monetary policy comes in. So what can we do in the financial sector? And that's really where I think the big things are, financial and the payment system. So on the payment system, I'll start there and then I'll end with financial. On the payment system, we take the weather patterns very seriously because, again, if we don't have cash in places, people use cash more in emergencies. They just do. It is the vehicle of exchange. So we have to have it there so that people feel confident and trust that they can get what they need in the time of crisis. So our payment systems folks look at this regularly. How do we get things? How do we adjust it's a big supply chain management problem itself. How do we adjust the supply chain to ensure not only that it's efficient and cost effective, but that it's resilient to anything, but weather is becoming a more important thing. So on the financial system, and that's where I think the bulk of the work at the Fed is taking place, for a while, we've been hearing from banks and companies that climate is an increasing risk for them. And in our supervision and regulation of banks, along with other regulators, our primary job is to think about the risks that they have and the risks that are emerging. That's what we're responsible for. So there I see us in partnership with what we're hearing from our financial system, really thinking about these scenario plans. So a scenario analysis is a a predecessor to a stress test, which isn't something that we're doing right now. We're not stress testing on climate. Other central banks are, but we are not yet. But it could happen down the road if the scenario analysis proves that would be a useful thing to do. A scenario analysis just imagines what would happen to the financial system and the banking sector if certain events unfolded in certain ways. And you have a range of those, the scenarios from kind of bad, medium bad to really bad. And then you imagine what happens to the capital of banks when they have to fend off those sort of bad shocks, and what happens to the financial system because banks are highly interconnected with it. And I think we're just starting that now and working on that hard, but we learned a lot from the financial crisis when we did the scenario analysis and ultimately the stress test. And so you asked me a really direct question, what will that do? Well, I'll go to the pandemic, if I may, as an example. We put this in place for banks, stress tested, ensured they had the right capital buffers, gave them feedback on that. They responded, and we had a remarkable, in my mind, success with the banking system during the pandemic. Banks were the helpers in our recovery, helping distribute funds throughout the economy, lifting, which is what banks are meant to do. And that, I think, is in part because we had these rigorous ideas in mind that banks were working with us on so that they were well prepared. And that would be the idea with climate. Ensure that banks are well prepared so that when we have climate events, and especially if they increase in frequency and magnitude, that they are able to withstand them and be a source of growth and recovery in the economy, not a source of restraint like they were in the financial crisis.
I think a natural question that arises from scenario analysis is related to a question that I asked earlier. And so if you feel like you're repeating yourself, I apologize. There are lots of scenarios that we might analyze about risks over a 10-year time horizon. Do you think we should be doing more scenario analysis? Are there other emerging risks that are similarly as risky as climate that you think we're ignoring? Or when you look on that time horizon, do you think that most of the risks are covered? I mean, we do scenario analysis for leverage, we do scenario analysis for other sort of macroprudential issues, and is this really the one that's kind of not being addressed?
I think we are looking at other risks, and let me just name them here. So one that I think everybody was blindsided by is pandemic risk. We hadn't had one since 1918. And while we had pockets of disease, SARS and things that have come up, they were isolated. And so this has brought economies across the globe to their knees, basically. And we have to, the health experts would tell us that this is not something that we can just assume won't happen for another 100 years. So part of our work here, we have a team of people who actually taught themselves all the epidemiological models, added important economic data. This is something happening across the profession, as you know. Economists are the new helpers on the epidemiological group. But I think this is really important because what we're learning is when scientists of any field combine their energies and resources, we get better answers. So that's something we're very focused on, among others, is just what happens when you get a pandemic. Do you get more used to it so you're better able to mitigate its onset? And then what happens to the supply chains? And then we're hearing from our contacts, and we're in dialogue with them. These are big firms, small firms. What do you do to help yourself should we get another one of those types of shocks? And what I'm hearing a lot lately is people were very much driving for cost effectiveness in the supply chain. And now they're recognizing that cost effectiveness is one, but resiliency is another. So I would assume that we'll get some transformation in supply chain management after the pandemic. And so that's another risk we're working on. Another risk that I think we've been working on and is just getting more pronounced is, what do you do when fiscal agents across the globe have put a lot of resources into fighting off the pandemic and now have run out of more policy space if we face another shock? The Federal Reserve and central banks across the globe already are out of policy space. If you think about how many are constrained by the zero lower bound, we've already had to bring out our alternative toolkit, asset purchases, et cetera, to mitigate the outcomes of shocks. And so I really worry a lot about that that's where most of my focus is how do we respond when we're going to repeatedly hit the zero lower bound, when the fiscal agents aren't able to absorb in the way that they might have been if we had less debt across the globe and we hadn't just come through, or not even come through, a global pandemic. Those are real issues, because societies and economies are going to have to imagine, what do we do when our buffers are low, whether it's policy space buffers for the central bank, or whether it's spending buffers that are limited for the federal governments across the national governments across the globe.
So earlier you had, I think, helpfully suggested defining things that you don't think we should do, and saying what you don't think is happening as a way to help sharpen a focus on what you actually think should be done and what you actually think things are doing. Let me, in the spirit of that, let me ask about a couple of proposals that are out there for things the Fed should do. It's been suggested that the Fed should use its regulatory powers to reduce the flow of bank lending to climate-producing industries. It's been suggested that the Fed set up lending facilities for climate investments, things of this nature that are, I think, much more aggressive than doing economic research or doing scenario analysis. Would you like to address, your thoughts on some of those more aggressive proposals?
Sure, and I'm going to start with two things that are really important to say. First, we don't make fiscal policy. And if the elected officials, which we've all elected, decide that we should do this, if Congress says, Federal Reserve, these are your new mandates, then we stand ready to do what the Congress asks of us, because that's the role. That's the Federal Reserve responds to the mandates Congress gives us. So that's the first thing. This is not my decision, really. It's Congress's decision about whether we should be doing that. The second thing I'll say is that everything I'm going to say and have said through my whole thing is really my remarks, does not represent the Federal Reserve System more broadly. And that's an important thing as I venture into this topic. So I worry a lot, and I think we always have to think about this, that there's this trade-off. And worry a lot means worry is not even the right word. One of the jobs of, I worked at the Fed a long time. I care deeply about the institution. If you care deeply about the Federal Reserve, you have to care deeply about our independence, because we have a long history of having that independence serve the American people better than it would if we didn't have that independence. We make monetary policy without political pressure. Even if people think there's political pressure, it doesn't actually permeate the halls of the FOMC when we make our decisions. And that's a critical aspect of what we do. The one way to preserve that I think needs to be underlined and emphasized is to have us not be part of the allocative mechanism in our society. We don't pick winners and losers. We have lending powers, not spending powers. If we get in the business of choosing one thing over another, especially without congressional direction to do that, because this is what we as a society have decided we want, then that challenges that sense that we're independent central bank and that we are doing something apart from the political system of the day. And I care deeply that we preserve that. And it's not just because that's how I view things. It's because if you look at the central banks across the globe that have been successful, they have been independent. When those two things merge, that then you end up in situations where that is not the checks and balances that you want for an economy, and bad outcomes can emerge. And I think it's one of the strengths of our democracy that we have checks and balances in all aspects of what we do, and the central bank and the goals we have are just part of that. So just to reiterate, if congressional leaders decide that the Fed should have more of these responsibilities, we all stand ready to do what we're supposed to do. But stepping back as a person who's worked for the Fed a long time, reads a lot of history, and as an economist, I see the real benefits of maintaining an independent central bank and having us not pick winners and losers in any of the discussions that emerge in our society.
What about, and you mentioned this briefly earlier, what about stress testing against natural disasters that could come from climate change? Do you think that would that be appropriate?
Well, I think it's too early to say that right now, because right now, I mentioned this earlier, when we start with scenario analysis, why do you start with scenario analysis? Because you need to get sophisticated in even what the data are. Do you have the right data? Do you know the landscape? And so to put this in the stress test at the moment would be, in my judgment, premature, and you don't see us doing that. What you see us doing is the due diligence, the hard work, right? Data collection. Governor Brainerd just gave a speech on this that lays out clearly where we are on these types of things. So I think that ultimately we might want to stress test like we do for a variety of other things, but just understanding and scenario planning and being in discussions with financial institutions, that is the first step. We have to do that very well before we can ever think about putting this into some sort of a formal stress test.
Do you want to address, you again, briefly mentioned things that the other central banks around the world, and the Bank of England has been more aggressive on climate than the US Federal Reserve System. The European Central Bank actually has a mandate to support the European Union's kind of general economic policies, which is a more expansive mandate than the Federal Reserve System has. Would you like to comment on actions that other central banks are taking and how those might, help people to understand your thoughts on what the Fed can or should be doing?
Absolutely. So you said it, different central banks across the globe, and you mentioned too, the ECB, Bank of England, they have different mandates than the Federal Reserve. And Congress is decidedly giving us this, I mentioned this before, a narrow but important remit. And it does not include doing things that facilitate the fiscal side of the house. It doesn't include that mandate. It's price stability and full employment, and then the payment and financial system. So what I do is I start from that. This is what Congress gave us. These are the remits we have. We will do our best there. So then I think about, then why are other banks ahead of us, really? And they are. It's because in those governments, they decided some years back that these were critical risks. They have largely, those countries have largely been ahead of us in terms of identifying climate as an emerging risk to their economy and their well-being. And so the banks were naturally responding. What I see that is this is really going to be helpful information for us as we develop our own plans of how to best respond in the financial system. So the Bank of England is starting stress testing. ECB has stress testing for its banks. This is something that you can really imagine we learn from and we participate in globally. I just had a fireside chat with the managing director, Ravi Menon of the Monetary Authority of Singapore, and they're starting those types of things. So we are going to be learning and catching up, if you will, to some of that. But I think this is the right time for it. Our banks are coming to us and saying, these are emerging risks. We have to think about them. We manage risks. And so I see us as now getting the information we need to do the job that we always do, which is be prepared for the future. But I think it would be premature to say we will do this, or we will do this, or we will do this, because we're still in that place where we put these committees together, we're assessing the risks, we're collecting the data, we're doing our scenario analysis, thinking about this. From all of that work, we'll emerge what the next steps are. And to front run them with, okay, I think we should do this or we should do that. One of the things I really like about the Fed, sometimes we get complained about that we're too slow, but we are methodical and we do our homework so that we actually know how best to respond to the risks ahead.
Let me remind people, please, to send in your questions. You can email them to mariana.mitchell@aei.org, or you can tweet them to us with the hashtag AskAEIEcon. On the subject of the mandate, Mary, you're clearly correct about the narrowness of the mandate. And I've always viewed that as a real source of strength for the Fed and for the U.S. economy as a whole. And I wonder, let's say some of these risks materialize. People don't want, it's hard to get a loan to start a business on South Beach, or economic activity in California slows because of wildfires or things of this nature. Isn't the best thing the Fed could do to help support the economy in the face of those risks, to double down on the mandate, on the existing mandate. In other words, rather than broadening the focus of the Fed to include things like climate change, wouldn't the risks that materialize because of climate change actually argue the opposite? That because of a changing climate, the Fed needs to focus more than ever on the simple basic things like promoting full employment and like maintaining low and stable price inflation.
Well, that's actually what we do. So there's a distinction between what we study so that we can understand the landscape of the economy and what we're responding to on a day-to-day basis. And so I'm going to use trade policy because it kind of gets us out of the an amorphous risk that's emerging as opposed to something we actually just lived through, right? So let's think about 2019, if I may take us back to 2019. The risk that we were really facing was global headwinds and trade disruptions, disputes between China and the US. And we were hearing from our context, and you see it in the data, that this was slowing economic activity in the United States. So we weren't saying we're responding to trade policy when we lowered the interest rate in 2019 two times. We were saying what Chair Powell communicated, which is there are global headwinds and tempering factors on our economy that we have to lean against if we're going to achieve full employment and get inflation up to its 2% target at the time. And subsequent to that, we have a 2% average inflation target. But we didn't have conversations about we have to offset trade policy problems. We have conversations about there are a number of factors, and some of it was geopolitical risk at the time. We don't have to quantify what each of those factors does specifically, but we do know that these big headwinds blow against us, and we have to lean against them to achieve our goals. So the same thing, just take that same logic and apply it to, should we get a lot of climate events that occur? Well, if climate events occur and they're bridling the growth of our economy and putting us below our potential, then it would be our job to lean against the risks that are there so that we can achieve full employment and price stability. It would not be, oh, there's these events, so we have to lean against climate. It's leaning against risk, and climate is one of those risks. And that's why I always go back to trade policy, climate. I came to the Fed in 1996. At the time, we were studying welfare reform. If you remember, Newt Gingrich and Bill Clinton navigated through that and got a compromise, which was welfare reform. Well, that poured a lot of new individuals into the workforce. If we hadn't thought about welfare reform, we wouldn't know that all those single moms were now entering, and we wouldn't recognize that labor supply had just gone up, and we might have pulled back on the economy at a time when we were getting increased supply, which would have been short of our full employment and price stability goals. So that's the framework we look into it. And so if we can, if your listeners, if all of you can take nothing else from this, please don't think of us as climate, interest rate. Think of us as risks, interest rate. Why would you use the interest rate? To achieve full employment and price stability.
So I think you've been admirably clear about the Fed being a creature of Congress, and if Congress says that you should be creating lending facilities for climate investments or whatever, that of course you would do that because that would be the law. If not, then that wouldn't make sense. I think it'd be helpful to talk a little bit about the politics of this situation vis-a-vis Congress, and a concern that some people have is that the Fed moving into some of these issues like climate change, even if it's just research, even if it's just scenario analysis, even if it's just stress testing, changing the stress test or things of that nature, that might risk the Fed's independence, which you earlier, I think, quite correctly argued was really central to the Fed's success. Another worry that people have is that some people that some members of Congress may be turning to the Fed and that might actually slow progress on Congress addressing climate change. That if members of Congress can say, we're taking action on climate change, we've asked the Fed to do X, Y, and Z, that the Fed isn't equipped to address climate change nearly as well as the fiscal authority, nearly as well as Congress can, and that in a sense the Fed's work kind of inadvertently gives Congress and the executive branch a pass on this issue. Is that something that you're concerned about, or that the Fed should be concerned about?
Well, let me take all of those questions and sort of start with something that maybe listeners don't know, is that so I started, as I said, in 1996, and I'll go through the areas where we have, as an institution, received considerable feedback that maybe we shouldn't be working on these issues. The first one was welfare reform. Then there was a lot to do with immigration. Well, immigration matters. Not because we're trying to manage a social issue or an elected officials issue, the fiscal authority, but because it determines how fast the labor supply can grow, and if that really matters for price stability and full employment. So I remember when I was working on immigration and thinking about how much immigration was affecting labor supply across the country, I had a lot of calls trying to convince me that, if we study that, we're actually unwinding the very independence that we rely on. That's been, as you said, nicely a source of strength for our economy. So I thought about that a lot as a younger economist in the Fed. And I came to this, and the reason this is so relevant is I'm still there and I review it all the time. I don't think any idea you have that's not regularly reviewed can ever be a good one. So I regularly review this idea, but back then I thought carefully about, is that true? And I made a commitment to myself and to the institution that if I get pushed around by the fears of politicization, then I actually won't be serving the very people who trust me to serve them, because I have to know how immigration is going to affect labor supply in order to understand how quickly our economy can grow and what the threshold for full employment is, and ultimately price stability. So I'm going to apply that same logic now to things we've been very vehemently criticized for it in by some commentators, and that is our work on equity and our work on climate. So I see those two things as the same as welfare reform, immigration. I was criticized for studying trade policy and how it affects the economy. I mean, there's a lot of, anytime we touch with the time, I actually worked on Social Security reform and what we would do there. These are all political kind of third rails. And then the Fed studies them, and people worry we'll lose our independence. We shouldn't just focus on losing our independence. We have to focus on earning the credibility of being independent. And the way I believe we earn credibility each day is to tell the American people, this is our remit, we're sticking to it, but we are committed to understanding the things that would damage our ability to respond to you when there's a shock and you need us. And that's why we're studying equity. We need to understand equity to understand two things. What's the distribution of outcomes in the United States that might help us understand whether we've really achieved full employment? And this is just like the pandemic. If you look at workers like ourselves who can telework and go on Zoom, it looks like a booming economy. If you look at all the workers who were displaced in more in-person services, it looks like a struggling economy. If we didn't look at both sides of that equation, we would be short of our responsibilities to promote full employment, which isn't just full employment for certain people. It's not just the average, and increasingly the average number, whether it's inflation or full employment, doesn't reflect the full distribution of the outcomes. And it's our job to understand those. Same thing with climate. Climate's just another risk coming onto our shores and across the globe, coming onto our earth. We have to understand it. And if we don't understand it, then I think what will happen is we'll be blindsided. And if we're blindsided, then I think the American people have every right to question whether we're serving them, whether we're fulfilling our responsibilities. So what I've learned by working in the Fed is it's so important that we're transparent. We say what we can do, we say what we can't do, and we communicate that effectively. So that comes to the last part of your question. Have been, I think, and you may disagree, people may disagree, so I'm not saying this is truth, it's just how I look at it, I think we have been a very successful and high functioning organization. Our response in 2019 to make sure that not only did we lean against those headwinds and lower the interest rates, the focus on getting banks, make sure they're well capitalized so that they can weather a shock, the support we gave to the economy through the pandemic. Those are the kinds of things that I expect. The new framework, the monetary policy framework, that's what I expect from the Fed, and I think we've done it. But when we do our job well, then people look to us to solve things we cannot solve. And we cannot solve climate change. We can't mitigate all the risks out there. We can't solve the deep inequities and inequality in the United States. We can't. Those are not the levers we have. We can alert people to the issues. We can talk about how they affect the economy and how they'll bridle our growth going forward. But the elected officials and basically every one of us as citizens have to decide how we want to manage those. And we will stand ready to do our best to respond to whatever comes.
Well, I think that's a good place to conclude our discussion on climate issues. Unless President Daly, is there anything else you wanted to address on that before we move on to another?
No, this was super wide ranging, and I have to say I really appreciate the questions because just being able to say clearly what we can do and what we can't do is as important as doing it, right? The communication part of this has to be there, or else people are rightly confused about what it is we're actually doing. So I really appreciate the ability to go in deep on some of those things.
Yeah, I completely agree with that. One question that we have been getting from our viewers won't come as a surprise to you. Inflation is on people's minds. Again, transitioning the conversation to a discussion of current economic conditions and the economic outlook. Opinion polls, public surveys show that the questions that we're getting are not unique. That this is on the minds of the public, and it's a source of concern. Obviously, this is squarely within the Fed's mandate, of course. What are you thinking about current price inflation? There's a lot of talk about inflation being transitory. I think that the American people hear that as being the same as temporary, and for a lot of people, I think the fact that this has been going on for several months, suggests that it really isn't temporary. Where do you think things are, and where do you think things are headed?
Sure, and I completely understand. I mean, the inflation numbers we've seen lately and over for many months now are higher. They've lasted longer. They're eye-poppingly high in some areas, and when you go to the supermarket and or if you're trying to buy a used car, you pay prices that are high, and you haven't experienced that type of high price and importantly price increases in a very long time. So rightly, people wonder if this is just what we've got, and maybe we should respond with a policy action that would mitigate those things. So let's go back then, and I'm going to start with something very simple. As goes COVID, so goes the economy. And when I look, and that's so important because it's going to help define what transitory means. So what I mean by transitory, and I'll speak squarely again for myself, is that it is not expected to persist when COVID is waning, as COVID wanes. Because right now, if you look at the inflation numbers we're seeing, the bulk of them, not all of them, we're getting some spread through other goods and services, but the bulk of them are related directly to what we would call COVID sensitive sectors. So we've got this big increase in demand. Consumers, I don't know about most people, but consumers have more money than they're used to having, and they're spending it on, they've rotated their spending from services and travel and things that we do when we were not trying to manage COVID. I know if you come to the office, you have to eat out. You're supporting a broader economy that's service-based, all the way to consumer durables. Most people have bought some new thing for their home. Bicycles, you couldn't keep them on the shelves. Everybody has a home gym now, some version of something that they can use. We watch TV like crazy, so we put all kinds of home theaters in there. All these are responses to being restrained across the board. So now we have these huge bottlenecks because demand is high and continuing to rise, and supply constraints haven't been going anywhere. And supply constraints are there because of COVID, right? COVID comes and the supply chain is a amazing global, it's just an amazing foundation. And it's more fragile than any of us thought. And it's not just that one chain link in that fence broke, it's that multiple ones broke. So, a good example is maybe a month ago, I can't remember the exact timing, Vietnam had to shut its ports because it had to lock itself down. Vietnam's a huge producer of goods. And so that's a chain link that just falls completely out and everything gets backed up. And for most of our products, they're made in all different kinds of countries with value add everywhere. Inputs are going into the final product, which we see, but they're dependent on so many things. So that's affecting our supply chains. So now why did I tell you all these details? Because when I think about offsetting inflation, what I realize is if we raise the interest rate today and it takes 12 to 18 months to restrain activity with the interest rate increase, what I would see is almost no effect on supply chains because supply chains are affected by COVID. This isn't going to open the ports and get more goods through. It won't put more trucks in the port of LA so they can unload the ships faster, but it will absolutely slow the trajectory of growth going forward, which we could find ourselves then in a place where we have missed full employment. We haven't got employment back up to the levels that it could be. And we might even miss on our price stability goals because as COVID goes away and the supply chains come back to full fruition, inflation would come down. So, I always like to point to other people who have made a good arguments that I think lay these things out. And so Governor Quarles gave a speech, I think, 2 days ago, where he laid, a colleague of mine at the FOMC, he laid this out very clearly. And I would point anybody who wants more to read about it to think about reading that speech, because it's another good resource. But the key point that I would like to make is that, this is a risk management problem. And my risk management is this: no one knows. And if people tell you they do know, I think they are probably exaggerating. No one knows what inflation is going to be really next year. Forecasting, the world is really uncertain because COVID's not behind us. So what we have to do is we have to say, what would happen if we're wrong? So if I'm wrong and the inflation persists more and it falls more into next year, even though it modifies or moderates relative to these high eye-popping levels, it moderates, but it still is above 2, then we can raise the interest rate. But if we forecast that we're going to raise the interest rate now, and we even worse do that, then we've actually bridled the economy. And if we're wrong and inflation comes back down to 2, if the people who would propose that are wrong, then we've bridled the economy. We've left millions of workers on the sidelines, not able to come back in. And that's a cost to them. But the other thing I'd like to mention is it's a cost to us as an economy. If we end up with labor force participation at the end of this pandemic that's lower than it was coming into the pandemic, we will be farther behind all of our industrialized competitors who have higher numbers of working age people participating in the economy. That's a direct cost to our potential output, and then thus a direct cost to our overall prosperity.
So at least in my view, important driver of actual inflation are the expectations about future inflation that are held by households and by businesses and by market participants, and those expectations have been drifting upward. Households expect above target inflation not only next year but over the next several years. The bond market expects above target inflation really over the next decade, and businesses are very concerned about inflation over the next year and longer as well. Kind of relating our previous discussion to inflation expectations, some people are concerned that if the Fed is venturing into climate change, if the Fed is venturing into issues of racial equity, that even if the Fed is in fact able to do that without putting at risk its mandate for low and stable price inflation, that the simple act of the Fed venturing into those areas is going to affect inflation psychology, and that could make it harder for the Fed to achieve its goals for price stability. Would you like to address that?
Okay, sure. I'm going to try to parse out this part, and start with inflation expectations. So absolutely, we focus a lot on inflation expectations, because one of the things that you depend on is that inflation expectations remain well anchored. What we saw in the 1970s was inflation expectations they didn't become unanchored. They were never anchored. And then, we had cost of living adjustments. Cost of living adjustments, prices would go up, cost of living adjustments would adjust. So wages would go up one for one, and that would increase prices. And we just saw this spiral. So we don't live in that world anymore, where there's that direct connectedness between wages and prices so clearly one for one. That's not the world we live in, but we do take the lesson from the 70s that inflation expectations are important. And so that's why you saw several decades after the Volcker disinflation, where thinking just about the credibility of the Fed. What do we want? And so we had really, so powerfully anchored it to that people thought 2 was a ceiling, 2% inflation was a ceiling. Then we come up with our new framework, and our new framework says average 2%. And what you saw is inflation expectations, especially in the market participants who seem to live on our every word, they drifted up, which is what we wanted, right? They were stuck kind of low. We moved them up. This is a better place to be than, say, the ECB, and certainly than Japan, because now we've got them firmly anchored where we want them to be. Okay, so then we start getting these high, as I said, eye-popping readings on inflation, things that make people, they're rattling. Not only do you feel it in your pocketbooks, but you get worried. What we have seen is that household and business inflation expectations for 1 and 3 years have risen sharply. When you look historically, that is typically what happens. They rise sharply on 2 things, really: food prices, gas prices, and labor input costs, right? Those are the things they rise on. What's also important to recognize is they come back down when inflation starts to moderate. So what I'm expecting to see is inflation will begin to moderate as we get through some of these worst parts of the COVID shocks on inflation, and those inflation expectations will drift down. If they don't, or if you say the psychology of inflation expectations starts to change, and so market participants, businesses, and households start translating these 1 and 3 year outlooks into broader outlooks, like, boy, we're going to have higher inflation for a long time, well, then that would be more problematic. But so far, I've seen those longer run inflation expectations in market participants come up, maybe even a little more than I would like them to. But I think that requires us to be even more communicative, to unwind what is this unusual narrative I see developing, that just because we're not acting means we're not thinking. And that's false. Standing pat, being patient to wait for the uncertainty around the data to emerge, is not the same as being asleep. It's actually an action. And standing pat sometimes takes a little more courage to stand in the wake. People would like us to act on a lot of things, but that's not what you want from your central bank. You want your central bank to do that risk management and say, right now, this is the best outcome for policy. And on this point about if we think about other things, do we lose touch with what we should be thinking about? We're a big organization. We have a lot of people thinking about these things. And really, if you want to be a policymaker of any type, and I think this holds for Congress too, you have to have a characteristic. You have to be able to think about today hard and spend a lot of time, worrying about stuff that's going on today. And you have to keep your eye on the ball of the future. Because if you don't, then you're constantly reacting. And we have to be proactive, get planned. We have to make sure we have all the resources and things we need for the future while we manage the situations that are today. The way I say it to my teams is we have to work with the economy we have and plan for the economy we will get. And that's why we study these equity and other issues. And my final point I'll make on this is there is this narrative that's also false, that we are just starting to study equity, and I would make it broader than racial equity. It's actual equity. I think a lot about the rural-urban divide, the displacement of so many people in the middle Western states, the Middle West where I grew up, that lost their jobs to globalization and never have recovered really from that shock. There are so many gaps in our economy that if we don't understand them, then we might find ourselves pulling up short of full employment, and that would be not doing our job. So it's not something new. We've always thought of it. It's getting a lot of attention now. I think largely because the whole world's thinking about it, not just us, but we've always thought about it. And climate is an emerging risk. So of course, we're just thinking about it now, but we've thought about historically all the things I've already named, welfare reform, trade policy, immigration. This is just the newest risk. And so we're thinking about it today.
You've mentioned full employment several times, obviously, because that's so important to the Fed's mandate. Let me ask you about the labor market. Final question about current economic conditions. Here's an argument that the labor market is extremely hot. The number of unemployed workers for every job vacancy is at a record low. The number of job openings is at a record high. Workers are quitting their jobs, which is a sign of their confidence in their ability to find a job that's at least as good, if not better, than their current job at record numbers. The unemployment rate has been coming down. We've been adding jobs at a healthy clip. Perhaps most importantly, we have wages growing at 5% annual rate. Wages in leisure and hospitality are growing at an 11% annual rate. All that really suggests that the labor market is very, very strong. At the same time, workforce participation hasn't really improved among prime age workers since at least the summer. Arguably, hasn't really improved for even longer than that. And we're still, 6 or 7 million jobs short of where we should be, where we would have been if there weren't a pandemic. Those statistics argue for a labor market that's really extremely weak. All of those statistics, to my understanding, are accurate. So how do you put them together and paint a holistic picture of the labor market?
Sure. And I'm going to go back to the discussion we just had about inflation. So there's two concepts that we have to keep in mind simultaneously. It's not easy. So I'm not saying this is easy, but it is what I think about. There are the current dynamics we see, and there are the underlying dynamics that we think are forming but they're harder to see because we have these current disruptions. So with inflation, I said, I think a lot of this is that transitory, it's COVID related. I would argue the same is true in the labor market. So let me give you some reasons why I think that's true, why what looks to be a tight labor market in any standard model we would run, this would look like a tight labor market. But if we look at the other statistics you said, the 6 to 7 million workers still on the sidelines, not back to the labor market, the labor force participation, the workforce participation rate being pretty low right now relative to where we think it could be, those would call for this weaker. And I think it's really the same thing. Underlying labor market conditions are not at full employment. But the current situation, which is very much affected by COVID, looks really tight. So the job that we have then is to dig further into the data. And we use a combination of things. We talk to employers, our contacts, we talk to small and large, we talk to individuals, labor unions, et cetera. What are you seeing? And then we look at the data. And here's the picture that I see. Again, we check it all the time, data dependent and all, but here's what I see. I see workers who, for many who are going back on the front lines, they're worried about COVID. That's first of all. But as we get more vaccinations, people become less worried, more confident. But here's what they're really worried about. They worry about the fact that at any given day, they have kids in school or parents in elder care. On any given day, they can have a COVID outbreak and then they're quarantined. And I had a friend who had one kid in quarantine at home, another kid Zoom school in school. So she had to drive one kid to school for his class and then drive back home and homeschool the other kid who's on the Zoom. These are both young kids, first and second grade. So that for her job life is completely disrupted. And after doing this for 18 months, she decided to take a leave of absence. Does she want to work? Absolutely. Does she feel like the pandemic is not a great thing? Absolutely. Her life is basically completely, in many ways, blown up relative to where she'd like it to be because the infrastructure that supports her ability to go to work has been affected so dramatically by COVID. But now let's multiply that by countless moms, countless dads, countless children of parents who need elder care. There are a lot of disruptions that interrupt people's ability to work. But when I look at the statistics on opioid deaths, on the unemployment of prime age workers, men and women both, when I look at the pockets of unused and underutilized labor that we have, and I compare that to where we could be and where we're going to need to be to remain globally competitive with our industrialized nations that we compete with, then I see a world that's not at full employment, a world that has an economy that has a lot more to give. And then it's about getting through this transition dynamic. And one of the things that I tell employers, I mean, I have a lot of contacts and they ask me these same questions. And I said, well, how quickly are you hiring? There's boatloads of workers out there and many are applying. Oh, we're very picky. Well, one thing that you can do is you can relax on both sides, right? So workers are picky right now because they're deciding if you want to work at a restaurant and they have a lot of, I don't know how many of you know this, but if you work at a restaurant, you have a lot of hours and thus earnings uncertainty. If the restaurant's not busy, they send you home. So people are saying, well, maybe I'd rather work at a warehouse in a distribution center where the hours are fixed. So now I'm going to quit and look for that work. So workers are being choosy to fit a new job into their life and jobs are available. But firms are also being pretty picky. And so every time firms tell me that it's so hot out there, they can't even find anybody, I ask them what their time to hire is. And I say, how many applications are you getting? How quickly are you hiring people? When I hear they're stretching it out and being very, very choosy, then I realize it's probably not completely to full employment.
President Daly, you've been so generous with your time. I see we're a little bit over, and I
apologize
for that. I have two young kids as well, and every time we get an email from the school, my heart stops because I think today is the day that
today's the day
for 2 weeks, or that really is how it feels. I hope that the Fed doesn't give up on those 6 or 7 million workers, and I completely agree with you that our goal as a society should be to get those folks back to work. Let me infringe upon your time with one final question. The Fed has been looking at its policies around buying and selling of securities by Fed officials. I don't want to ask you to comment on anything specific, but I wonder if you would like to just comment on the importance of public trust to the Fed's ability to achieve its important mission.
Absolutely. So it's very simple. Trust is our most important tool. And it's important for so many reasons. It matters for interest rate setting. We set one interest rate and it moves through the entire system because we're a credible and trusted organization. But it goes way beyond that. Why don't we have runs on banks in the United States? Why do people not go and take, everything out of their bank account at the ATM when they're worried the cash won't be available? Because they're not worried cash won't be available. They're not worried their bank will close down. And they're not worried that we will be asleep on important topics that matter to them, jobs and prices. And those are the things that are critical. So when we get a disappointing shock to that trust, then that's painful. But we are committed as an organization, and you saw that yesterday in Chair Powell's press release on what we're doing. We are committed as an organization to not only have trust, but to earn it again and again every day. And when we find ourselves in a situation where the public says, well, I don't know, that doesn't seem like what you should be doing, we look at that. And the big lesson, I think, from all of this is that reviews of policies and procedures need to be more frequent, so that we're not ending up behind and someone has to raise their hand from outside, but we're internally looking at this on a regular basis. I'm really pleased with the guidelines that were put out yesterday. We stand fully ready to comply with all of those, and in many ways already have been. And the main thing I want your listeners to know is I take this seriously. We all take this seriously. Trust is our most important tool, and it is our job to earn it from you each and every day.
Well, President Daly, thank you very much for your time this morning. Apologies again for going
No
a little
worries.
bit over. I think this has been a great conversation. I've certainly learned a lot, and I think it's been really helpful to people who are interested in this topic to learn more about what you're thinking, what the San Francisco Fed is doing, what the Federal Reserve System is doing on this important issue. So thank you so much. Thank you for your service to our country, and thanks for being here today.
Thank you. It was a complete pleasure, as I anticipated it would be. Really, really great to be with you.
Thank you. Thank you all.